Welcome back. If you just joined us, this is Taking Stock. I'm Pimm Fox. Crude oil prices, they have been falling in recent days from a record high of $98.62 a barrel last week. Now, despite the recent drop, is $100 a barrel oil inevitable? And what effect would that have on investors and on the U.S. economy? Matt Simmons is the chairman and CEO of Simmons International, and he joins me now from Houston. Matt Simmons, welcome.
Thank you.
So let's just go down right to $100 a barrel oil. Do you think we're going to get there, and is it meaningful, and why?
Well, I suspect we'll get there. I think it's been astonishing to see how hard it was to get oil prices through 40, and then it took about another 6-8 months to get through 50, and then a long time to get through 60, and somehow we went from 80 to 98 like we were sprinting. And I guess what I find so interesting now that everyone's talking about the inevitability of $100 oil is how the connotation is that is unbelievably high, and most oil experts are saying, well, it can't stay that high. And I come back to square one and say, divide a barrel of oil into a term we human beings can understand, which is a cup, and at $100 a barrel is 15 cents a cup. And I just don't happen to believe that 15 cents a cup for an invaluable, scarce resource that's now in decline is too expensive.
Well, given that, if indeed that's so, that it isn't expensive, do you think that it will continue to increase in value beyond $100 a barrel? And given that it's 15 cents a cup, as you're describing, that's more than perhaps what people are used to paying. Will that cause any slowdown in the economy?
Well, there's sure a lot of economists that thought that at 30 and 40 and 50 and 60 and 70 and 80 and 90 and think it today. Having traveled around the world quite a bit, I try to keep my eyes open. And in London 2 weeks ago, it was really interesting to ask the cab driver, what are you now paying for petrol? And he did the math and converted it and said about almost $9 a U.S. gallon. Well, they've been paying these prices for ages, and it doesn't affect their use one iota. So I don't think the idea that when we go beyond 100, it's the consumer that basically buys it by the gallon and doesn't even think about the cost per barrel.
Well, but we haven't seen it show up in the price per gallon in any significant way recently. Do you expect prices at the pump to increase, let's say, past $3.50?
They need to, because right now the refinery spreads are awful. And refineries are too old. They need to do a lot of maintenance. But if they're not making any money, then they can't do maintenance. And then we have too many fires. So it's sort of winding up into a vicious cycle. But what we all need to sit back and realize is that there are many, many, many parts of the world, for various reasons, but primarily taxes, that have been paying $7, $8, $9 a gallon for their finished product of oil. And if you do the sums and sum that up times 42, it's basically $300, $400 a barrel of oil. We've been there, done that, and we're still using it at record amounts.
But, Matt, let me put two things to you. First is, aren't driving distances in at least some parts of the United States, isn't that a little bit different than driving distances in, let's say, the UK or in continental Europe?
Yes, it is, but the driving patterns are what's important. And when you go to Australia, they've been paying $6, $7, $8 a gallon for their gas, and they travel longer than we do.
Well, then, if that's the case, then let me ask you, if that's a sort of a driving pattern, what about the use of gasoline in the economy? Are we able to squeeze much more GDP out of that barrel of oil?
Oh, I would think so. I think that probably I wouldn't like to be a long-term investor right now in bottled water, because I think that basically at some point that people are going to start buying less bottled water, which is they're paying way, way more for oil, maybe buying less coffee, maybe going to one less sporting event. But I think that we have a long ways to go before anyone can make the serious statement that, well, it's now too expensive.
All right, Matt, stay with us. We're going to take a quick break. Up next, OPEC oil ministers meet in Saudi Arabia this week. I'm going to ask Matt Simmons if he thinks they're going to increase production. I'm speaking about energy prices with Matt Simmons. He is the chairman and CEO of Simmons International. He joins us from Houston. Matt, I just want to turn our attention a little bit to OPEC now, because they are going to be meeting in Saudi Arabia, talking about perhaps production. And I just want to throw out one statistic and get your reaction to it. In Saudi Arabia, they are pumping 1 million barrels of oil a day less today than they were 2 years ago, yet the number of active rigs that are operating in Saudi Arabia is triple, is 3 times what it was 3 years ago. What does that say about the importance of OPEC in the whole oil equation right now?
Well, OPEC is extremely important in the whole equation, but what is astonishing is how so many people just glibly assume that OPEC still has 2 million barrels a day of shut-in capacity, and then almost everyone that thinks about it acknowledges it's all in Saudi Arabia. You talk to some people on the ground in Saudi Arabia that know what they're talking about, and they'll say that's preposterous. We have no excess capacity. So for the first time in years and years and years, as demand inches ahead of supply, there is no more spare oil to turn on. And there is a reason why the rig count went soaring. Their fields are old and in decline.
Then if that's so, if indeed we're talking about OPEC not being able to increase production in a meaningful way, let's say particularly Saudi Arabia, where do you think the price of oil is headed? Can you give us any kind of guidance in terms of a number?
No, I can't, because I don't think there's any ceiling that you can point to that with any reliability. But I think we know a lot from Economics 101 about what happens when demand exceeds supply. And what happens in the oil markets is we finally just continue drawing down stocks until finally we have a shortage. The last time we had a physical shortage in the United States, it took 90 days for the price to go up threefold.
And do you think that that is likely again to happen?
I think it's a big risk. Now, timing, I couldn't guess, but we're too tight. Demand has been growing far stronger than anyone thought. We now know that high prices doesn't dent demand, and supply is starting to decline. This issue of peak oil, which a lot of people poo-poo, I think basically there's some growing evidence that we peaked in global crude oil in May 2005, and we've been basically living on borrowed dreams ever since.
So, Matt, what do investors do given the scenario that you're laying out?
Well, I think, first of all, just understand the dynamics, that these prices aren't so remarkably high. There's going to be a phenomenal amount of wellhead revenue to reinvest, and the big issue is how wisely will we reinvest that revenue. We have a very rusty oil and gas infrastructure. Our refineries are too old, our pipelines are too old, our drilling rigs are too old, our people are too old. If we basically get about rebuilding all of that, we would have such a blue-collar boom that in all the infrastructure companies, some of these funny companies that haven't enjoyed prosperity in years, that make heat exchangers and valves and flanges and so forth, they're going to have their work cut out for us. If we don't rebuild our refineries and we don't rebuild our drilling rigs, then we're going to have the indignity of supply going down and infrastructure being half of what we can supply, and that is a really world-class problem.
So, Matt, would you be investing, let's say, in the large integrated oil companies as well as the oil service companies? We heard from their earnings reports that their margins did affect their profits. Is that going to be a continuing story?
I think the bigger continuing story is that the major oil companies' production base is too big and too old and too much in decline, and none of them can grow their production anymore, regardless of how much they spend. So what you're really buying is basically a play on the price of oil. You get into the smaller, nimble companies in the E&P business, you've got some fabulous companies. The service industry is going to have to be an enormous recipient, but again, they have challenges because their assets are too old too. Everyone is scrambling to find people.
Are there any specific regions of the world where you think we're going to see some heightened activity? Is it going to be on the west coast of Africa? Are we going to see more in the Gulf, deeper rigs? Russia? Where are we going to see all this pent-up activity start to express itself?
Well, one of the problems we have today is we're effectively out of high-quality drilling rigs, and so it's going to be really interesting to see. So there will be some period of time where rates have to go way up, but we're not going to see a big activity increase because you can't basically increase activity without increasing the number of rigs we have, and our rigs are too old.
So are we going to see, investing in rig manufacturing, would that be a good business right now?
Absolutely, absolutely. The whole infrastructure play is going to be, if it's not a good investment, then we have a lot bigger problems than any of us are thinking about.
What about, when we talk about energy, you don't want to leave out natural gas. I just want to get your thoughts. How important is the price of natural gas in looking at the price of crude?
Well, it should be very important because, in my opinion, natural gas is probably a more valuable inherent source of energy than even crude oil, and we've had the biggest disconnect between natural gas prices only because we haven't had much of a winter the last couple, and we now have what we call an ample amount of gas in storage, and so we've sort of fallen asleep at the wheel. But at some point, I think we end up getting BTU parity between oil and natural gas, and then long term, I think it goes to a premium. So when we had $64 oil and $16 natural gas prices after Katrina,
I'm sorry, Matt Simmons, chairman of CEO.